Not doing what we love in the name of greed is very poor management of our lives. All there is to investing is picking good stocks at good times and staying with them as long as they remain good companies. An investor should act as though he had a lifetime decision card with just 20 punches on it. Beware the investment activity that produces applause. The great moves are usually greeted by yawns. Buy a stock the way you would buy a house. Understand and like it such that you'd be content to own it in the absence of any market. Calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands a romantic. Diversification is protection against ignorance. It makes little sense if you know what you are doing. Do not take yearly results too seriously. Instead, focus on 4 or 5-year averages. For the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. Forecasts may tell you a great deal about the forecaster. They tell you nothing about the future. Half of all coin flippers will win their first toss. None of those winners has an expectation of profit if he continues to play the game. I insist on a lot of time being spent, almost every day, to just sit and think. That is very uncommon in American business. I read and think. So I do more reading and thinking, and make less impulse decisions than most people in business. I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. If past history was all that is needed to play the game of money, the richest people would be librarians. If returns are going to be 7 or 8% and you're paying 1% for fees, that makes an enormous difference in how much money you're going to have in retirement. If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. In the business world, the rearview mirror is always clearer than the windshield. Investors should remember that excitement and expenses are their enemies. It is a terrible mistake for investors with long-term horizons, among them pension funds, college endowments, and savings-minded individuals, to measure their investment risk by their portfolio's ratio of bonds to stocks. It's been an ideal period for investors. A climate of fear is their best friend. Those who invest only when commentators are upbeat end up paying a heavy price for meaningless reassurance. It's better to have a partial interest in the Hope Diamond than to own all of a rhinestone. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. Money is not everything. Make sure you earn a lot before speaking such nonsense. Most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. Never invest in a business you cannot understand. One can best prepare themselves for the economic future by investing in your own education. If you study hard and learn at a young age, you will be in the best circumstances to secure your future. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. Only when the tide goes out do you discover who's been swimming naked. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Our favorite holding period is forever. Predicting rain doesn't count, building the ark does. Price is what you pay. Value is what you get. Read 500 pages like this every day. That's how knowledge works. It builds up, like compound interest. All of you can do it, but I guarantee not many of you will do it. Remember that the stock market is a manic depressive. Risk comes from not knowing what you are doing. Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. So smile when you read a headline that says investors lose as market falls. Edit it in your mind to disinvestors lose as market falls, but investors gain. Though writers often forget this truism, there is a buyer for every seller, and what hurts one necessarily helps the other. Speculation is most dangerous when it looks easiest. Success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get other people into trouble in investing. Successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. The best chance to deploy capital is when things are going down. The best thing that happens to us is when a great company gets into temporary trouble. We want to buy them when they're on the operating table. The business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. The investor of today does not profit from yesterday's growth. The most important investment you can make is in yourself. The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. The most important thing to do if you find yourself in a hole is to stop digging. The stock market is a no-called strike game. You don't have to swing at everything, you can wait for your pitch. The stock market is designed to transfer money from the active to the patient. The 3 most important words in investing are margin of safety. The years ahead will occasionally deliver major market declines, even panics, that will affect virtually all stocks. No one can tell you when these traumas will occur. There is nothing wrong with a know-nothing investor who realizes it. The problem is when you are a know-nothing investor but you think you know something. There seems to be some perverse human characteristic that likes to make easy things difficult. Time is the friend of the wonderful company, the enemy of the mediocre. Today people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. What counts for most people in investing versus saving is not how much they know, but rather how realistically they define what they don't know. What we learn from history is that people don't learn from history. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. Wide diversification is only required when investors do not understand what they are doing. Widespread fear is your friend as an investor because it serves up bargain purchases. You don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with 130 IQ. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. Thank you for watching. Please, don't forget to like, share and subscribe to our channel.